Hello, and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insights into the topics and issues that we've been discussing here at Quilter Cheviot. So as to not miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following hashtag QC Weekly Comment on LinkedIn. My name is James Coker, and I'm an investment manager based in our London office. I'm delighted to be joined by our regular commentator and head of fixed income, Richard Carter. Richard, another week, another deluge of tariff announcements. We seem to be running out of ways to discuss them without sounding jaded. At least last week, the drama was punctuated by some important reports, allowing us to gauge the health of macroeconomies and the corporate landscape. Touching briefly on the latter, it was a mixed report card for the mega cap US tech. To name a few, Amazon disappointed with weak forecasts for operating income. Apple positively surprised investors with a return to growth in Chinese iPhone sales, and Meta beat expectations for revenue growth and forecast AI investment. However, it is the macro I'd like to focus on today with you, Richard. On Wednesday, US GDP growth came in at 3%, ahead of expectations. On the same day, we also saw core PCE, which is the Federal Reserve's preferred inflation gauge, come in at 2.8%. An increase from the previous reading of 2.6. With GDP recovering from a contraction in Q1 and inflation re-accelerating, the Fed seemed initially justified in holding rates on Thursday. The two FOMC members who dissented, preferring a cut, must have felt some vindication when, on Friday, it was revealed that the jobless rate rose last month to 4.2%. Furthermore, non-farm payrolls increased by 73,000, significantly less than expectations. But the damage wasn't limited to July. The big story was revisions to the prior 2 months, which lopped off 258,000 jobs. Taken together, the numbers entirely changed the tone of recent trends. The average 3-month payroll gain went from being around 150,000 before Friday's release to just 35,000. Richard, what was it about the labour data that requires such a sharp revision?
Morning, Jason. I mean, it wasn't some devilish plot to undermine Donald Trump, much as he might think it was. I mean, there is a wider kind of issue at the moment with a lot of economic data, not just in the States, actually here in the UK, about sort of declining response rates. And, these surveys are sent out and unfortunately, you're not getting as many responses as we used to. I mean, around these particular numbers, there were some sort of seasonal adjustments being made, but mostly it was this issue of not enough responses or responses coming in late. So they decided that they had to revise down these numbers quite significantly. I mean, quite a few economists have been saying they were a bit surprised how strong the payrolls numbers had been recently. So there was, for some of them, it wasn't a surprise to see revisions, but the extent of them was pretty significant.
Thank you, and I like the term you use, it not being a devilish plot, because despite that, Trump's reaction seemed to be to shoot the messenger. He said in a social media post that he had instructed the Bureau of Labour Statistics Commissioner's dismissal, or as one headline rather churlishly put it, made her a statistic. Well, firstly, I wasn't aware that Trump could fire, or at least insist on the removal of a commissioner from an independent body. Does this move significantly undermine the value of future data? And if so, what does that mean for the US debt status as a safe haven?
Yeah, it's not good. It was a bit of a surprise that he could react quite so quickly to this and make the dismissal, as you say. First, I think the first thing to make people aware of is that the BLS doesn't produce all economic data in the States. So, there's other different bureaus who produce things like the GDP numbers, retail sales. You have more independent surveys like the ISM. So, it doesn't completely undermine the value of future data, not at all. It will be interesting to see who they appoint to take over at the BLS, because if that's some real political appointee, I think there will be question marks over some of the future data, potentially. But I think we're some way off that at the moment. I think the bigger picture is, as you've asked, is what does this mean for the US's status? It's part of a wider trend, unfortunately. whether it's the Fed or other branches of government that seem to be under attack from Donald Trump, and the things we never used to worry about in terms of the behavior of US presidents, in terms of respect for institutions and kind of upholding democracy and the rule of law. Unfortunately, with Trump, that seems to be being eroded. So yes, I mean, Treasuries did very well on Friday, actually, because people start to worry about potential recession. But it certainly does make us nervous about longer term the status of US Treasuries, definitely.
Certainly. And I think you raise a really crucial point here, which I'd like to probe further into, which is this idea of the politicalization of data publications, upon which so many investment decisions are based. And I mean, the dismissal of this figure sort of had this worrying echo of another seemingly independent figure which Trump's had animosity with in the past. So Trump has not made secret his animosity for Fed Chair Jerome Powell. They've bickered in person, and on Friday, Trump once again said publicly that Powell should be put out to pasture. Even though Powell's term doesn't end until sometime in 2026, has the resignation of Fed Governor Kugler on Friday created an opportunity to insert a dovish, more Trump-friendly voter?
Yes, absolutely. I mean, let's be honest. The treatment of Powell by Trump, Powell's just mostly been vindicated in a lot of his decisions, and he's trying to do his best of a difficult job. The treatment has been nothing short of disgraceful. Unfortunately, these things that we would never have anticipated in the past, certainly under Biden, have just become almost normal practice under Trump. So it is worrying, because you start democracy and, I say, institutions can gradually get eroded, and people just accept it because of they almost expect this bizarre kind of behavior from Trump. I mean, the early resignation of the latest Fed Governor Kugler, yes, that has given Trump an opportunity to put an appointee. It's not quite. There are some sort of checks and balances. The Senate need to approve it, but he could sort of speed that process up and put in a friendly face. Certainly, I mean, you've still got the other governors on the committee who have a vote as well. So whoever takes over in the new position won't be able to completely change policy or anything like that. But they could be seen as a bit of a shadow chair and a real competition for Powell. So that might further undermine his position. And say, it goes back to worrying about the US status and institutions there. We've seen in places, like Turkey or Russia or wherever, these undermining of these supposedly independent, institutions, and unfortunately, that seems to be happening in America too.
Absolutely. I mean, as if there wasn't enough Trump weight being thrown around. The clock on America's tariff deadline struck on Friday morning. So those countries who had not agreed deals within the last 90-day reprieve saw tariffs applied. Now, arguably, most levies were lower than those threatened on April the 2nd, which back then sent markets into a tailspin. Plus, the significant trade deals with Japan and the European Union have been reached, while talks with China and Mexico are still ongoing. This probably explains why some of the market reaction was a bit more muted on Friday. However, what has become more apparent is the geopoliticalization of tariffs. On this podcast, we've discussed before how Brazil was slapped with a 50% duty despite running a trade surplus with the US. Similar BRIC nations have been punished for non-alignment, including India recently. Then on Friday, Taiwan did not only receive a 20% tariff rate, which is significant, but its president was reportedly forced to cancel a transit through New York due to a pushback from the US. Rumors swirled that this was in order to court Chinese opinion as trade talks continue. Richard, I didn't think anybody really saw the 39% tariff rate being placed on Switzerland. Though it does have a trade deficit with the US, presumably a lot of its pharmaceutical exports are protected under this Section 232 Act, which aims to minimize disruptions to the import of critical materials. Could you help us to understand why Switzerland was hit with such a big tariff rate?
Well, I don't think they saw it coming either. I think they basically dropped the ball politically. Maybe they were a little bit I don't want to say it, but maybe a bit naive in handling Trump. I mean, I think they thought they were going to get a sort of similar deal to the EU, sort of 15% tariffs and carry on sort of fairly happily. But there was a supposedly disastrous telephone call between the Swiss president and Trump, where Trump was, the big sort of mafia boss, hoping for some sort of, concession or some promises of purchases of vast, US equipment or whatever, and then Switzerland would get their deal. But unfortunately, that wasn't forthcoming. The Swiss president's coming from a lot of criticism in the domestic press, apparently, and they didn't really have an offer for Trump he was happy with. So he slapped 39% tariffs seemingly at random on them, and that's it's bad news for them. I'm not surprisingly not gone down very well in Switzerland, but like with all these deals, there's still room for negotiation. If you can come up with an offer that Trump accepts, then maybe those tariffs will come down at some point. But it was a bit of a shock for them by the sounds of it.
Yes, there certainly does seem to fit in that model of big words, place a large tariff and then negotiate from that higher rate, something a bit lower. Bit of a tilt back to our own domestic monetary policy committee. The Bank of England's rate setters meet on Thursday. Can you give us a bit of a insight into what they might decide on Thursday?
Yeah, it's a tough one, UK. I mean, we all know the economy is not exactly firing on all cylinders, as Rachel Reeves is very aware. So rates probably do need to come down, but the problem is you've got quite sticky inflation at the moment. It's well above the Bank of England's target. So they are in a bit of a bind, but we do expect there to be a rate cut on Thursday, 25 basis points. There might be some voters who think they should do more. There might be some voters who think they should leave rates unchanged. But overall, it looks like a 25 basis point cut is on the cards, albeit I dare say they'll probably say the next one's not going to be for a while because of these sticky inflation numbers. But yeah, rates continue to come down in the UK, but it's a pretty slow process.
Marvellous, thank you. And what are current rate expectations by, say, year end? Are we still
so the market's expecting this one to happen on Thursday, and then another one before year end, and the trough is likely, or as far as the market's concerned, going to be around 3.5%. So that's not actually that far away. Clearly, if we see some big, the payrolls are very interesting. If we see some, big change in the situation in the States around the employment market, and worries about recession increase, and that those rate expectations to 3.5% could well come down.
Okay, thank you. And on that cheery note of falling rates here in the UK, albeit with some potential reason for, potentially negative reasons for it, seems like a good place to leave this, and to thank you, Richard, for those great insights, as well as you all for listening. Did you enjoy our discussion on the podcast today? We'd love to hear from our listeners, so please do review the show and share it on your socials, tagging us at QuiltAchieveit. So as to not miss a future episode, please tap the subscribe button. We'll be back next week, but in the meantime, please head over to our website on www.quiltachieveit.com, where you can read the accompanying market overview as well as subscribe to our weekly comment newsletter. You can stay up to date on our thoughts on the market news, industry insights, and upcoming events and webinars on our website or via our social media pages. Finally, do you have any questions you'd like to ask one of our experts for the next podcast? Simply submit them via the weekly comments page on our website. We'd love to hear your questions. And that's it for today. As always, a big thank you to Richard for your time and to you all for listening. Until next time, goodbye.